Hi, I'm Jeff Flynn, the founder of Aspen Ridge Capital, which is a firm that buys mobile home parks through syndications. And today I want to explain what a syndication actually is. It's not something we hear about a lot, especially in school. We get taught almost nothing about real estate investing. Surprise, surprise. In fact, when I did my first syndication, I was telling my mom about it, and she said, "Syndication? You mean what the mafia does?" I said, no, well, obviously, I wasn't going to just openly tell my mom I was joining the mafia, but that kind of illustrates how little information is out there about what a syndication is. So what I'm planning to do in this video is walk through a very simple explanation of what it is so it makes more sense. And please take this all with a grain of salt. Obviously, I'm not an attorney, so this is not legal advice on exactly what a syndication is. And also, there's many different ways deals can get structured. Even syndications, they can be funds, they can be one-off deals, they can be all sorts of different syndications. So this is just going to be a high-level overview of what the general term syndication is referring to. All right, so let's get into exactly what a syndication is. Now, a syndication, put simply, is a way for multiple people to pool their money together to buy a larger property that they otherwise couldn't, right? One of the biggest difficulties with commercial real estate is that the price tags get big very quickly. So some people might have the capabilities to go buy a single family house, and then by themselves, they buy a duplex. And then they want to get into larger projects and they realize, hey, that 20 unit apartment complex might be $10 million, or that might be high, but so much that they can't come up with the down payment for the next deal. Now, a syndication is a way for a bunch of people who like investing in that asset to do so together in one deal by basically pooling their resources. Now, when you do this, there's basically two parties involved. There's the general partners, which is the person who is not investing the money, but doing all the work to find the deal, close the deal, and operate the deal after it closes, and find the manager and deal with the tenants and the projects of the property and all sorts of work related to the property. And then the limited partners are the people who just invest their money. And then pretty much what they get is they get a share of the deal, they get profits, they get updated on the performance of the property quarterly, monthly, sometimes annually, sometimes, but they take a limited role, right? So that's basically the two pools. There's a general partner and the limited partner. Now, I mentioned earlier that general partners don't invest the money, and sometimes you will find that the general partner does, but typically what they're doing is they're buying shares as a limited partner too when they're investing. So they're investing as a limited partner and they're also the general partner, because the general partner is basically responsible for doing all the work. Now, why do people like this model, right? If somebody could buy a property on their own, why would they want to share a portion of the ownership with someone who's not investing? That's because there's a lot of work involved in real estate deals. And sometimes people don't want to do the work. They just want to invest the money and get returns and do something else with their time. And that's exactly why you find that LPs typically love investing in syndications. There's no management headaches. It is truly 100% passive, right? All you've got to do as an LP is invest your money, and then you look at the reports that you get updating you on how the property is going. But the general partner is doing all the work. So it's not a passive investment for the general partner. They're just doing a ton of work in exchange for their ownership of the deal and their portion of the cash flow and all that sort of stuff. The other part that LPs love is that it gives you access to bigger deals and sometimes better deals than you could find your own. I'm a full-time real estate investor at this point. I find mobile home park deals all day long. That's what I do for a living. I have a much better chance of finding a really good home run deal typically than somebody who's just doing it on the weekend, right? And so that gives people access to those kind of deals when somebody is working in it and has a lot of scale in a particular industry. It also allows you to put money into a much, much larger deal. So say you have $50,000 you want to invest. If you're just going to buy a deal on your own, you can buy a $250,000 property if you put 20% down. Or you could put that $50,000 into a $10 million deal where they're raising $3 million and you just own that portion, however many shares that buys you. Now, on this chart here, we're looking at basically the difference between syndications and other investments. So the two that I included here were owning the property yourself and investing in something called a REIT, which is a real estate investment trust. So most people are aware of what owning the property by yourself is referring to, but a REIT is not as common knowledge. So the best way I could describe a REIT is basically a publicly traded company that just so happens to own real estate, and you can buy shares in that company. So think of Coca-Cola, for example. If you buy stock in Coca-Cola, you have some shares that you could sell pretty quickly, which is an advantage, right? It's liquid, but there's no real tax benefits to doing it. And there's also no control over specific assets or knowledge of specific assets. You're basically just buying stock in a company, and that company buys real estate. Whereas a syndication, you're buying stock in a company that's going to own one particular deal. So that's really the main difference there, okay? Now, there's pros and cons to all of these. And basically, wherever you're at on your real estate journey, whatever is important to you, it's important to weigh these pros and cons. What's interesting to me about real estate is that the knowledge of syndications is actually pretty low out there, which is why I'm trying to do a lot better of a job educating people on how syndications work. So let's go through all of these quickly to talk about the differences. Now, when you own the property yourself, you're going to own 100%. That's obvious. You get full control. All the decisions are yours, which you may like, you may not like, depending on your personality. The time commitment, it's going to be high, right? You've got to deal with the tenants, the maintenance, and operations. You might hire a property manager, but you still got to manage that property manager. And then the tax benefits, obviously, they're all yours. It's your property. Any benefits go solely to you. There's nobody else involved. That's pretty obvious. And then in terms of liquidity, it's still low, right? If you need to sell that property, you got to list it, you got to wait for it to close, then you get it. So it's not as liquid as a REIT, which we'll go into next. And then the transparency, it's up to you. You're doing all the work yourself, so there's no transparency. It's all you. Now, with a REIT, the best way to describe a REIT or a real estate investment trust and that I can think of is basically think of Coca-Cola and how you can buy shares in Coca-Cola. And imagine Coca-Cola is just a company that buys real estate. That's essentially what a REIT is. Like, you don't know about a particular deal. You don't know about a particular asset type. It's just a publicly traded company that operates in real estate. So with that, you don't really get control over decisions, right? I guess technically, like Coca-Cola, you could vote for something, but unless you're going to own a huge percentage, you really don't matter, honestly, in that case. And there's really no time commitment, though, which is a benefit. A REIT is fully managed and professionally operated, so there's nothing you have to do. And one of the weirdest things about it that's different than a syndication is there's really no tax benefits. Again, you're just owning stock. Now, sure, that real estate that they're buying, there might be tax benefits involved with that for the business itself, but you as the owner of those shares typically don't see any of those benefits. And in terms of transparency, you're going to see things like the dividends, the reports, the stuff that publicly traded companies have to do, but it's not really something where you're going to know, hey, this particular property is performing this well. That's not the level of information you'll get. And a syndication falls somewhere in between these two things. So you do own shares of a company that own one particular property most of the time. Now, again, some syndications can own multiple properties. For the sake of this video, I'm trying to keep it simple. So just say, hey, you bought $50,000 worth of shares in this company that's going to buy this particular deal. That's what a syndication is. Now, there's limited control if you're the limited partner. Obviously, general partners typically have most of the control. But again, I can't say one way or another how this goes. On most deals, it varies. Sometimes the general partners give voting rights to limited partners. Sometimes they don't. Sometimes they give voting rights on particular things, but not all things. So you want to make sure you read the operating agreement. Because remember, in this case, you're buying into a particular company. So you want to know how that company operates. And one video is not enough to explain how a particular deal you're looking at operates. In terms of the time commitment for a limited partner in a syndication, there really is no time commitment. Whatever it takes you to read the documents and get comfortable with the deal, that's basically what I would consider the time commitment. You invest, and then that's it. You're going to get your reports, you're going to get your tax info, you're going to get distributions if there are any, and you're going to get updates from the general partner, but there's no commitment on your end in a syndication. So this is worth highlighting here, but the liquidity in a syndication is low, and that's something that people need to pay attention to. I've mentioned how it's similar to a REIT, but with a REIT, just think of what happens when you sell your shares of Coca-Cola, right? You go and you click sell as soon as there's a buyer, which is almost instantaneous, it sells. Syndications are not that way. Sometimes, according to the operating agreement, you may not have a right to sell your shares. Or if you do have a right to sell your shares, you have to sell your shares to the owner. But it's not something as easy as click, sell, and you get the money. A lot of times you are in the deal for the life of that deal. So that's really important to understand. If you're going to be investing in a syndication, you've got to make sure that money is money you do not need for a very long time, and you could just live completely without ever seeing it. That's the level of illiquidity that you have in a deal. I would argue that it's almost a little bit less liquid than owning the property yourself, because you don't necessarily have the choice all the time to sell it if you want to. So if that money's in a home, for example, and you want to sell your home that you own by yourself, you can do that. If you've got money tied up in a syndication and you want to sell, you might not be able to. So definitely pay attention to that and make sure it fits your strategy accordingly. And then in terms of transparency in a syndication, it's usually pretty high. The property, you know the plan for the property, the general partner's predicted expectations for the property, what they project the returns to be. You don't know this for a fact, right? They're not promises, but you can look at the numbers of a particular deal and say, okay, these are the loan terms we're going to get. This is how the property currently operates. And you can know a lot about it before going in. So you can be very informed about the investment you're making. Now that wraps it up for this video, basically explaining the basics of syndications. Again, if you're interested in learning more about how Aspen Ridge Capital does it, you can book a call with me in the show notes here, or you can just go ahead and scan the QR code to get set up with a call with me personally, not anybody else. Just talk to me for 30 minutes about what we do, what your goals are, and how there might be some synergies there. So if you liked the video, I'd appreciate if you subscribe to the channel. I'm always working on putting out new content to help educate people on what syndications are, what Aspen Ridge Capital does, why I think mobile home parks are such great investment vehicles. Thank you.